When you think about billion-dollar deals, you might picture some lone wolf investor, right? Well, that image, it's pretty much dead. These days, private equity is a team sport. Seriously. So in this explainer, we're going to break down exactly how this massive shift, it's called deal syndication, is totally changing the game.
Okay, let's just start with the big question, right? In a world that's so hyper-competitive, how do you even win a billion-dollar deal? I mean, with everyone chasing the same hot companies, how do you get that edge? How do you actually close the deal?
Well, the truth is, the entire playbook has been thrown out the window. The old way, it was all about the classic leveraged buyout, the LBO. That's where one firm goes it alone, buys a company using a mountain of debt. Super high risk, but also super high reward. The new way, though, it's the complete opposite. It's all about teaming up, pooling your cash and your brainpower to share the risk, and of course, share the reward.
So you gotta ask, what's driving this massive change? Well, it all starts with this huge gamble that private equity firms used to take all the time. And we're gonna see exactly why that old go-it-alone strategy is just way too risky today.
It really just boils down to one thing: competition. And I mean fierce competition. You've got more PE firms than ever before, you've got big corporations jumping in, they're all chasing the same small pool of great companies. And you know what that does, right? It sends prices absolutely through the roof.
And look, the numbers here are just staggering. Back in the early 2000s, a PE firm might pay, say, 6 times a company's earnings. That was pretty standard. Today, that average has doubled to 12 times. Think about that. When you're paying that kind of insane premium trying to fund it all with debt, you're basically betting the entire house. It's a huge, huge gamble.
So with all that risk, a really clever solution started to emerge. And that brings us right to our next section. What is deal syndication anyway?
To put it simply, deal syndication is just a strategy where investors team up. That's it. So instead of one firm shouldering all the risk, you get multiple partners to pool their money, their equity, and their expertise to buy a company together. It's just a much smarter way to get a big deal done without having to take on a terrifying amount of debt.
And it's not like everyone just jumps into the pool at the same time. No, it happens in stages, which is pretty cool. You've got your lead investor, right? They're the ones doing all the upfront work, the due diligence, and they write the first check. Then, once the company starts showing some real potential, an early-stage partner might come on board. And down the line, when things are really humming, a late-stage partner can join in for the later gains. It's super flexible. People can even sell their shares at different times.
So, who are these partners? Who's actually on the team? Well, the lineup of players might actually surprise you. We're talking about a whole new cast of deal-making all-stars.
If you look at a typical syndicate, yeah, sure, other PE firms are a big slice of the pie. But the real game changer here, the rising trend, is corporate partners. And by that, I mean established companies, often from the very same industry. And then, of course, you've got your other financial investors, banks, and even the LPs, the limited partners, who traditionally just put their money into the PE funds.
And these corporate partners are so valuable because they bring way more to the table than just a check. We're talking deep, nitty-gritty industry expertise. They know how to actually integrate companies after a merger. They can even supply experienced leaders to run the new business. Honestly, just having them on the team sheet lends the whole deal a ton of legitimacy.
Meanwhile, you've got those LPs, the folks who usually just hand their money over to a PE fund. They're starting to think a little differently. They're looking at this and going, wait a minute, why are we paying a 2% management fee to the fund when we could just invest directly in this deal as a partner? It's a genius move for them, right? They get to bypass the fund and grab a much bigger piece of the action for themselves.
Okay, so all this collaboration makes a whole new strategy possible. And that brings us to Section 4, the Buy and Build Playbook. And this is where deal syndication really shines.
Just think about how different this is. The old LBO model was all about buying one single big company and then using a bunch of financial tricks, leverage, to squeeze out value. Buy and build is a totally different beast. Here, you're buying lots of smaller companies, merging them into one big platform, and creating value from actual on-the-ground operational improvements. It's a massive shift from just financial engineering to real operational know-how.
So how does it work? Well, the process is pretty straightforward, really. Step 1, you acquire a bunch of smaller firms in a similar industry. Step 2, you merge them all together to create this single, larger platform company. Step 3, this is the magic part. You drive value by combining their strengths and making them more efficient. And finally, Step 4, you exit by selling this new, powerful platform company as one single entity.
So just how important is teaming up for this strategy? Get ready for this number, 99%. Yep, 99% of buy and build deals rely on at least one syndicate partner. Let that sink in. This strategy is basically impossible to pull off on your own. It absolutely demands collaboration.
And if you look at who's powering these buy and build plays, who are the most critical partners? It's the corporate partners by a long shot. They make up a staggering 70% of the syndicate in these deals. And the reason is simple, right? To actually merge different companies and make them run better, you need people who've done it before. You need real operational chops. Your PE firm brings the financial wizardry, but your corporate partners, they're the experts at actually building the business.
So what does this all mean for the future of deal-making? Well, it all points to one thing, really. The big takeaway is simple. It's all about the network.
Now look, this whole syndication model isn't some kind of magic bullet. There are definitely trade-offs. On the plus side, the gains are huge. You're sharing the financial risk, you're getting way more expertise and resources, and the deal just has more credibility. But there's a flip side. The pains can be real too. Coordinating all those partners is a nightmare, rivalries can pop up, and you always have to worry about free riders, partners who don't quite pull their own weight.
So, what's the bottom line? It's that the entire landscape of private equity is transforming right before our eyes. We're moving away from a world of standalone, one-off deals and into a world of interconnected networks. A world where, honestly, your relationships might just be your most valuable asset. And that really leads me to the final thought I want to leave you with today. In this new era of private equity, it's not just about what you buy anymore.
It's about who you buy it with. That's the real question. In this new world, the quality of your network, the people you bring to the table, that's what's really going to determine whether you win or lose. Thanks for joining me.